In financial markets, a widely cited statistic is the 90% rule. 90% of retail traders lose 90% of their money in their first 90 days. They fail because they approach the market like a gambler at a slot machine, hoping for a lucky streak. Professional traders operate as the casino. They build a statistical edge, manage risk aggressively, and let probabilities play out over thousands of executions. Looking at this split screen, we can clearly see the difference between investing and trading. On the left, investing relies on a multi-year time horizon. You buy and hold assets, allowing capital to compound steadily over time. On the right, trading is entirely different. It requires exploiting short-term price fluctuations over holding periods that can last weeks, hours, or even just minutes. If we expand this short-term chart, we expose the primary flaw in retail trading. Novices stare at charts looking for geometric shapes, triangles, flags, and trend lines. Institutions look for liquidity. They analyze the market to find dense clusters of pending orders, like the glowing heat map zones you see here, which represent resting stop losses. Treating the market as a pattern recognition game leads directly to that 90% failure rate. To survive, you must abandon the search for magic shapes and instead adopt a strict mathematical system for managing risk and locating liquidity. This is a limit order book, the actual engine of market price movement. On the left-right, limit orders wait patiently, providing liquidity to the market at specific prices. To get into a trade immediately, you use a market order. These market orders instantly consume the closest available limit orders. Because you demand immediate execution, you pay the spread, the difference between the highest bid and lowest ask. Before you execute a single order, you must establish an ironclad rule for capital preservation. Professional traders rely on the 1% rule. This dictates that the absolute maximum capital you are permitted to lose on any single trade is 1% of your total account balance. This limits your downside while preserving your bankroll for future opportunities. Crucially, this 1% represents your maximum dollar loss, not the total size of the asset you are buying. To translate that 1% risk into a specific trade size, we use this exact formula. Position size equals your total account size multiplied by your risk percentage divided by the distance to your invalidation point. That invalidation point is your stop loss, the exact percentage drop where your trade thesis is proven wrong and you exit. Let's put this to the test. You have a $5,000 account. You are risking 1%. You identify a chart setup that requires a 5% stop loss to remain safe. Take 5 seconds and calculate your maximum position size. Your account size of $5,000 multiplied by 1% is $50. Divide that $50 of total risk by your 5% stop loss, and your maximum position size is $1,000. Notice the mechanics here. If market volatility forces you to widen your stop loss to 10%, your position size must drop to $500. A wider stop always requires a smaller position to keep your exact dollar risk constant. Running this calculation before every entry removes fear and greed from the equation. When you know mathematically the worst-case scenario is a controlled, easily recoverable 1% loss, you become indifferent to the outcome of any single trade. Now we apply this math to market structure. This chart displays a sideways, range-bound market. The price bounces against a clear horizontal ceiling of resistance. Retail traders see this obvious line, sell short, and place their stop losses just above it to protect their positions. They have just created a massive pool of buy orders. Institutions need those buy orders to fill their massive short positions. To get them, they engineer a stop hunt. They deliberately force the price to spike aggressively above the resistance ceiling. This fake-out triggers all those retail stop losses, providing the exact liquidity the institution needs to enter short. Immediately after the stops are hit, the price violently reverses back into the range. Knowing this, we structure our trade. We do not place our stop loss behind easily breached retail lines. Instead, we wait for the fake-out to occur, enter the market as it drops back into the range, and place our invalidation point above the actual institutional high. As the red risk box shows, our stop is protected by the very trap that just wiped out the retail traders. With risk defined, we set our take-profit target. This green reward box extends down to the next major liquidity pool at the bottom of the range. Visually, the green area is double the size of the red area. This guarantees a minimum 1-to-2 risk-reward ratio, meaning one winning trade will cover the cost of 2 consecutive losses. Reacting to obvious chart breakouts leaves you vulnerable to manipulation. Structuring entries around institutional liquidity traps transfers the statistical edge from the market back to you. To consistently execute these setups, you must utilize multiple timeframe analysis. Looking at this split screen, the daily chart on the left tells us the macro narrative. The market is in a clear uptrend, so we only look for buying opportunities. We then zoom in to a 15-minute chart on the right to pinpoint a highly precise, low-risk entry that aligns perfectly with that broader daily momentum. Excellent analysis will not save you from poor discipline. Accounts are destroyed by 3 behavioral errors: widening an active stop-loss, over-leveraging past the 1% threshold, and revenge trading after a loss. To prevent these errors, run through this checklist before allocating capital. 1. Direction. What is the macro trend? 2. Liquidity. Where are the retail stops located? 3. Confirmation. Has an institutional fakeout occurred? 4. Risk. Where is the precise invalidation point? And 5. Size. Have you calculated your position to ensure only a 1% exposure? Your assignment is to put this into practice. Open a historical chart and locate 5 distinct institutional traps where the price spiked past a support or resistance line before reversing. Then, assume a hypothetical $10,000 account, apply the 1% rule, and calculate the exact position size required for each of those setups. Surviving the market does not require you to predict the future. Ultimate success comes from acknowledging total uncertainty, controlling your dollar risk mechanically, and executing your strategy flawlessly when the odds are in your favor.